Okay, welcome. Today is August 12th of 2024. We are researching the company MAGNI Industries, Berhad. Uh, Ticker symbol, or actually the stock code is 7087. Company background. It was incorporated in Malaysia in 1997, listed on the second board in 2000, transferred to the main board in 2003. The CEO, and still the CEO currently, is Tan Sri Dato Tan Kok Ping, and the managing director back then is also the managing director right now, Tan Pawai Singh. Initially, the package business was the main business, but then they diversified into the garments and apparel business after acquiring South Island Garments on 2006. So, business overview. As I mentioned earlier, it was mainly doing flexible plastics and corrugated packaging, but then they diversified into garments, which now make up 91.81% in 2023. This percentage is in terms of revenue. So 91.81% of revenue in 2023 was from the garment segment. This grew from 76.2% of revenue in 2009. So more of their revenue is coming from the garment segment. So one major customer is contributing to the revenue in 2023, which make up 88.04% of revenue from one major customer. So this business, they export and import. They export a lot of their uh, garments, and they import a lot of their costs. So this business model, of course, has the risk of foreign exchange losses and gains. The packaging segment is deemed to be recession proof, which is mentioned many times in the annual report. It sees its offset printing packaging business before the year end of 2018. Now we look at the qualitative analysis. So they don't do any dividend policy, but they target a payout ratio under 40%. Although they don't have a dividend policy, they have been maintaining non consecutive dividends since 2000. So management ownership exceeds the external shareholder ownership. So this means they have more than 50% of outstanding shares. And management is also good at growing revenues with no use of debt. They haven't used debt since 2014. Around 2014, they have only used operating leases, which is debt. But during that time, before the 2018, they weren't required to put operating leases in the balance sheet. So it seemed like they had no debt, but actually they had a bit of debt through operating leases. But if you do not count them as leases, which they're still debt, but not to a substantial amount. But they could still grow year over year with no debt, which means that management's ability to grow revenue is very good. So management's adherence to Sharia compliance status for 15 plus consecutive years. This is since 2008. This can assure the investor that they will try to remain Sharia compliant, at least for the coming future. If nothing material impacts them, like taking on more debt or investing in more non-Sharia compliant investment vehicles or instruments. Management's risk mitigation measures in foreign exchange hedging. So I will talk about the foreign exchange hedging later into more details. And they have no dilutive options. They had before in the past, but in the recent 10 to 5 to 10 years, they haven't had any dilutive options. Quantitative analysis. So in this section, we'll just talk about the quantitative analysis, which is the bulk of the valuation or why you would invest in this company. I would say it's because of the payoff risk asymmetry, which we will discuss later. But right now, the market price as of today closing is 2.32 ringgit per share, which if you think about the net current asset, which is just the net current asset minus total liabilities minus any NCIs or non-controlling interest over the outstanding shares. I'll discuss with this later in more detail, but the net current asset covers 81.47% of market price at NCA or net current asset value per share of 1.89 ringgit. So we already see that the current asset covers, or the net current asset already covers 81.47% of market price. Quite a low risk investment in terms of how much you're paying. And then we go to the DCF valuation, or the discounted cash flow valuation, which comes to an intrinsic value of 4.67, assuming modest growth. So we are assuming modest growth to account for margin of safety, and that's the uncertainty of the business outlook in the future. Just to remain modest, and also with this modesty, still it's yielding a very high intrinsic value. So with this DCF valuation, there will be a detailed in the coming slide, detailed section. We have a median 10-year ROIC of around 28%. So ROIC generally entails that the management can grow their invested capital, which for the last 10 years is mainly the equity side. There was little to no debt during the first year, only operating leases. So 28% of invested capital, which is also the ROE basically, if we do not consider operating leases in the beginning of the year, which are a very negligible amount compared to the whole picture. So to 28%, which is quite high. And 10-year revenue compounded annual growth rate amounting to 7.5%. So in the DCF valuation, we assumed revenue to grow 5%. But the past 10 years, revenue has been growing at 7.5% compounded. No debt in 10 years, except for the operating leases, as I told you in the earlier years, especially before 2018 accounting standard changes. And then the median 10-year reinvestment rate of around 20%. Remember this number when we go back to the DCF valuation. So the dividend payout rarely exceeds 40%, which assures the investor that this dividends can be paid in the future. And the dividend yield is around 6% right now. And it provides safety for the investor that the dividend is not exceeding the net income, so that management is able to pay without risking losses in business opportunity or investing in a new business. CEO and managing director holds a total of 49.88% of outstanding shares. Only two people hold 49.88% of outstanding shares. So this signifies their confidence, and this is only two people. And they've been buying shares since the 2000, since their incorporation. I took a look into the annual general meeting, at least the questions and answers given in the fiscal year 2022 and fiscal year 2023. The fiscal year 2024 hasn't come out yet. So the question that, well, the answer that is most intriguing is these 4 points. So the major customer, which is the 88%, I think I said 88% of revenue comes from one customer. But this customer has partnered with MAGNI for over 35 years. And then the second point, someone asked about the resolution on issuing shares. Why would you need to do that when you are cash rich? They said they just wanted a mandate in place and they will issue shares when it is beneficial to shareholders. So this means that they're not necessarily going to issue shares just to issue shares, but they need a mandate in place. Third point is the reason to hold on a lot of cash is due to global economic uncertainties. So right now, management is still looking for investments and business opportunities, but they just keeping cash in a lot of fixed deposit, assumingly some also Islamic fixed deposit because it's Sharia compliant. That means that cash shouldn't exceed, or non-compliant cash or investment securities shouldn't exceed total assets. So the SC has approved this for, I said, more than 15 years, so it should be okay. Management is trying to get new brand contracts. So in this question, they were asking if management was trying to find new contracts beyond the one major customer. So they did, but this is no material effect on the company yet. So investment thesis. So due to the coverage of that current asset to market value, it is potentially a low risk investment and have a payoff asymmetry. This is following the concept of Monish Paribas' heads I win, tails I don't lose much. So there's a substantial risk also from one major customer, but it is mitigated by the long partnership over 35 years. Although packaging is a small portion of revenue, they provide recession proofing. So this 9% of revenue is deemed recession proof. Again, management has a lot of shares outstanding, and this signals confidence in the future of their company. Assuming a low rate of revenue growth, the fair value doubles compared to the current share price. Foreign exchange gains and losses mitigated through natural hedge and through forex adjustment programs from customer. So what does natural hedge mean? So they get revenue from the US in USD, and how they naturally hedge this is they pay their input costs in USD. So no matter how the Malaysian ringgit or Vietnamese dong do, it's still paid in USD. And then, of course, there's the other stuff that goes through the forex adjustment programs and other forward contracts which are not Sharia compliant, but they do not make a substantial amount. So even this mandate that they approved, it's only 10% of issued shares, less treasury shares. So even if they dilute by issuing 10% of issued shares, it will still be very undervalued through the assumption of the DCF, which again shouldn't, I mean, I didn't mention this earlier, but DCF shouldn't be taken as a truth. It's just a valuation method to see how pricey one asset is. It's not a certainty. But what is more certain is the price floor which is the net current asset. That is more probable. It is more likely to see the residual value of the company rather than the potential upside. So I want you to keep that in mind. So no dilutive options. Again, this is a very big plus. They had an ESOS, or like employment shares of options. That one during during the 2000s, but then they have no dilutive options for a while now. So the growth without external funding is for 10 years. They have growth in their revenue and also profit before taxes. This is very encouraging, and it's a good. It's very good for management to do this, as I mentioned earlier. So the risks, of course, I'll just go over them because we are kind of like repeating here. So customer concentration with the one major customer, that's the main risk I find. Foreign exchange risk, of course, very mitigated, but still there. They can move a uh, couple million ringgits just because of a 10% increase in the strength of the Malaysian ringgit, for example. They have high labor. In the past few years, the Vietnamese government has increased the minimum wage, so this maybe increases the cost of MAGNI for the labor cost. So a little bit of this is normal business risks. So the risk of higher wages from the increasing Vietnamese minimum wage. Of course, in Malaysia too, but it's been happening in Vietnam, so that is the focus of our risk here. Higher input costs arising from inflationary pressures. So this risk is associated with many companies around the world, even. And the fifth point is, so earlier I said in the AGM, the annual general meeting, they said that they're looking for business opportunities. So of course, if they do look for the management look for these business opportunities and they do fail, what do they pay? They use cash to pay for this investment and those business opportunities. So if they fail, they drastically can lower our net current asset by eating it up. So this will drop our floor price. So there's a risk of management inefficiencies or, uh, you know, their incompetency. So we have other normal risk associated with a business. So now this is the DCF valuation. Should take with very, very slight, just it's an estimate. Shouldn't be taken as a serious fact. But my assumption is the growth of revenue is 5%, which is lower than the 10-year CAGR, to provide for margin of safety in case of any downturn in the revenue side. And then tax rate to be higher than the past 5 years, just to maintain also the margin of safety. And we're also assuming a deteriorating EBIT margin. So as you can see, it started with 11% in the 2025 assumption, and then it ended up 9.1%. So this is just to say that they lose power in their price. Again, all for modesty in the analysis. And then reinvestment at 30%, which, if you remember earlier, the median 10-year reinvestment rate is, reinvestment rate is 20%, the median. So here we have a reinvestment rate, or the percentage of not no PAT, at 30%, which is 10% higher than the 10-year reinvestment rate median. So then we get the unlevered cash flow. Of course, we have to get the PV of the free cash flow, and then we have the terminal value calculated by 2%. So we're assuming that it grows 2% for the remaining foreverness, 2% till it just grows to 2%. And then we have we add cash, we minus debt, which is 0, and we minus the minority interest. They never had preference shares, but yeah, so it's 0 also. So then we get to an equity value of 2 billion. So this 2 billion is the supposedly market cap, equity value or market cap. And then we have to adjust it to reach the per share price, which is 4.67 ringgit per share. This is double of the current, a bit more than double of the current share price. So the probable payoff asymmetry. So as I mentioned earlier from the DCF, if we assume a 5% growth in revenue, we can get a plus 101.4% increase in share price or in fair value. But the negative outcome, if it loses its 35-year-long major customer, and we assume that the net current asset is getting eaten or like getting deteriorated by the reinvestments that it's made for 10 years. So I'll explain this net current assets being deteriorated by 10 years of reinvestments in the coming slide. So this says that the potential, the probable floor of the price is 40, I mean, it will decrease by 40.52%. This asymmetry is what attracts me into this company. So how do we get the net current asset value per share first? So we get the current asset, which is highlighted, the first highlight. And then the below that you see the non-current or non-controlling interest. That's the NCI. You have to subtract that too. And then you also have to subtract the total liabilities. So once you subtract those two from current assets, you divide it by total outstanding shares, which is the one highlighted to the right, 433,450,579. And then we get a ringgit per share of 1.89, which I showed earlier is covering the market value. And now the probable value floor or price floor. The median reinvestment rate over 10 years, this is not the reinvestment rate in percentages, but in number, is 22 million ringgit. So multiplying the reinvestments by 10 years will give us 221.3 million ringgit. So this is if the company loses the revenue from the one major customer and it loses all revenue, all it has to do is just keep on using capex and working capital. So reinvestment is made out of capex, net capex, which means capex minus depreciation, and then you also have to put in the investment for working capital, which is the account receivable, payables, and stuff like that. So when we assume all the reinvestments had been made for 10 years, it will come out to 221 million. So this is a very modest assumption because, again, if a company loses the major customer, it wouldn't reinvest as much, especially if it's making no revenue, which you're assuming for the next 10 years it's not making any revenue because it loses its major customer, which is like around 88%. So we assume zero revenue and zero revenue growth so that reinvestments will be keeping on going. So capex, and they still have to do their working capital, but they still get zero revenue, which makes no sense, but it's very modest and it's like the probable floor price if worse comes to worse. And then, of course, we subtract this 10 years of reinvestment from the NCA, which NCA, if you calculate earlier, is 819 million. So this 819 million, you subtracted to 221.3 million, you get 597.75 million, or 1.38 ringgit per share, which is 59.48% of market value. So this entails the floor price or potential or probable floor for the for the company if they lose the major market share, if they lose the major partnership. So of course, if you go back here, we can see that's why it's 40.52% down. It's because we still have 59.48%. So 1 minus 59.48%, we arrive to 40.52%. So this is how much we could lose if worse comes to worse and they lose revenue. They have to live from is net current asset value per share. Again, it can always go the different way. Maybe they try to find, like earlier, the risk of management trying to find investment or business opportunities that yield no benefit but only eat up their net current assets, which is, of course, the risk you're taking on when you are uh, investing in such companies. And that is the end of the research that I've done. I've read through their annual report since 2000, since their incorporation, but I skip every 3 years so that I don't keep on repeating kind of the same thing. I get the general idea of what they have done, where they have acquired GPS tech and yeah, and their cease operation of SIPP. So, if you have any questions, I'd be delighted to answer in the comments. Uh, Again, I'm very new at this, and this is just for information purposes. To do your own research, of course. It's a very low risk opportunity, I would say, but my views might be skewed. So you have to do your own research. And with that, I'll end it.